Eight right now with the recent downturn in the markets. The unprepared investor can run into some trouble. So we thought we'd bring in Paul Schatz, President and CEO of Heritage Capital, to bring us a little reality check and how not to panic. Good morning to you.
Good morning, my friend.
Nice to have you here.
Good to see you.
We were talking just leading up to this. That I've been watching this market a little carefully, not crying, but just kind of like very curious. And I'm trying to teach my son, who I think would do really well, get him interested in the stock market. But there's just not been a lot of good news lately, has there?
There hasn't. Look, the year has been. I was with Tim in January.
Right.
I said it's going to be sloppy, it's going to be choppy, it's going to be frustrating. A year that requires patience.
Good call.
But you know what? The magnitude of the decline is larger than I thought, and so people want to lay blame.
Right.
The blame lies squarely at the feet of the Federal Reserve. Everybody and their mom, dad, and grandparents knew 2 years ago, 18 months ago, a year ago, that prices were going up.
Yeah.
The Fed made a horrible bet, and Americans are paying for it because of inflation.
Okay, so let's talk about this. So we're now just about, in the official definition, a 20% correction. That's a bear market. When was the last time we had one? I'm putting you on the spot here.
Right, so it's March of 2020.
Right.
We went down roughly 33% in 5 weeks.
Okay, but that was COVID related.
There's always a related, right?
Okay, that's true.
And then before that, December of 2018, it was 19.9. You got to be careful. 19.9, they say, is not a bear market.
Right.
20.1, of course.
Right.
So there are other ways. A bear market, historically, is a generally lower trending period of stock prices over months and quarters. I mean, is the crash of '87, which we're down almost 40%, is that a bear market happened like that? So the longer a bear market or decline goes on, the more it wears at the investor's psyche, the psychology of it.
Yeah, because it's not a matter of you just saying, stocks are on sale, you could buy at the dips if you have a little money on the sideline, because it's almost like it's just like you said,
it's a grind.
Right.
This decline from the January 3rd, 4th peak to now, this has more been a grind, a la 2000 to 02, 07 to 09. I've said this so many times. This is not 2008.
Okay.
People looking at it and thinking, oh my gosh, 50%, 60%. This is not 08. The banks have too much money.
Right.
The banks are fortresses. The individuals are fortresses. People have money for a change.
Okay, so it's easy to say, or at least for the experts to say, don't panic. Easier said than done. Obviously, we should not be liquidating everything and putting the money underneath our mattress. What do we do?
So first of all,
if you say don't panic, I'm going to end the segment right now.
Right. So here's what I tell. When people always say now isn't the time to panic, when should you ever? There's no great time to ever panic.
Okay.
Listen, if you weren't smart enough in January and February to take action, listen, you're down 20% in the S&P, but you're down 30% in the Nasdaq, and a lot of those high-flying stocks like Teslas, like Roblox, like Roku, some are down 50, 60, 80%.
80%, right.
So.
Right.
Now isn't the time to say, you know what, let's throw those away. But a couple things. Number one, if you are in a taxable account, do some tax loss harvesting.
Sure.
Sell some losers and buy something similar. That's a smart strategy. It's going to pay dividends likely for years to come.
Get the write-off later on.
And also, if a lot of people are sitting on an awful lot of cash, highest cash levels in probably 12, 13, 14 years.
That's surprising given the way the market has gone up over the last 2 years. I'd have thought everyone was just throwing the money in the market.
No, so people have been investing, but don't forget, with all the stimulus that was going on in the country, you see low debt levels and high cash levels, huge checking account balances. If you're not a stock investor, bonds, this has been the largest decline in the history of the bond market.
Okay.
So if you say stocks, I'm timid, try bonds. To my view, between now and year end, bonds offer better risk reward than stocks do.
And be resilient and don't lose your head over this.
There's never been a time the U.S. stock market hasn't recovered. Right? Could it be months? I think it's longer than months, but the average recovery is, roughly 9 to 12 months from a decline like this.
Okay.
Because the Fed's not going to rescue the world, maybe this time is a little longer. But look, in 08, it took 5 years to recover. Then we went on to soaring new highs for years on end.
Very good. So stay the course. Don't panic. I'll say it. You don't have to say it. Paul Schatz, good
to see you. Thanks for having me.
Always good tips. You need to come back on more and tell us more. Don't panic. By the way.